Time. And all this fun.
Welcome back, everyone. How was your extended weekend? Good time. I always feel a little bit jealous on the weekends like that because on one hand, I do enjoy kind of the additional time off, but like this last weekend, I'm facing not only comprehensive exams for the graduate students, but also I'm on the search committee for the new School of Business Professional Studies dean. So I was doing evaluations for the I've been complaining to my grad students that about how many comps questions they had me grade. There was kind of some sheepish grins on everybody's faces. And so, yeah, I was busy doing that all day on Monday, and I didn't really get time off. So that being said, I think that's kind of that's the point where you start realizing you're an adult, where you just basically look at time off as a time to catch up on things that you need to do rather than time to take a break. So hopefully you'll enjoy what I did when I was first in public accounting. When I was in public accounting, we had meetings like training sessions that we had to go to, and some of these were in person. It's like, oh right, time away from the client. Yes, it's like the real world. The way that works is that at some point you reach a level where it's like, okay, the work doesn't go away. It's just additional time you have to spend on other tasks. Some of you may already be in that boat, and if you are, sorry, I'm just very, very sad for you. But I'm going to quit rambling now and do some actually course related reminders. So we are in week number 12. We have 15 weeks in the semester, which means that we got a lot of stuff coming up over the next few weeks. Does everybody know what's in 2 days? The next class session, the Excel assignment. Everybody really excited and enthused, and hopefully you're actually making progress on that and got that taken care of. I have not received any emails from anybody panicking saying my information's not in Morningstar or so. If you are finding yourself in that position, then please let me know. Hopefully nobody is, because I did give you enough ones to download all your information early. I don't know what it is. I think we just hit right at the quarterly peak where a lot of the information is adapting to new information for the quarter. But this happened a few times, but I have not got any emails yet. Does everybody know what's in a week from 2 days from today? Professional interactions are due. Professional interaction write-ups are due. So please make sure that you have gotten that taken care of. I'll look into that. Hopefully most of you have gotten your opportunity to resolve for professional interactions. I believe there is, again, one more opportunity on Friday, though I believe it also takes place during this class period. So if you tell me, Dr. Barnes, I'm skipping your class for professional interaction, you're going to put me in a tight spot. Yeah. So on one hand, I'm the one who's telling you to do the professional interaction. On the other hand, don't want to skip auditing. It's the best class of the day. Best class of the day. All right. Well, if that's the case, does everybody know what's happening 2 weeks from today? That is exam number 3. Exam number 3 is coming up 2 weeks from today. So we've got today, we're going to be wrapping up chapter 13, which will be on inventory. Then we'll be doing our final lectures for chapters 14, 15, and 16 next week, which will be our final content for the course. Then we'll have week 14, we'll have our exam. And then once we get done with the exam week, then we're going to be on to week 15, which to my knowledge, I don't think anybody's requested a day to present on. I could be fuzzy on that, but if you have a specific preference on a day, please let me know. I do know that there may be some events that interfere with the class session, so please let me know as soon as possible if you've got something a reason that you can attend class on one of those days so that you can present on one of the other days. It's really awkward if that happens. All right. Let's go ahead and talk about the auditing the inventory management process. So inventory is pretty straightforward. We've already talked about the concept of inventory in previous courses that you've taken here at Truman State. And so inventory management, it's going to be really pretty obvious and apparent what the concepts that relate to this are. We did talk about this a little bit in AIS, alluded a little bit to this, and so there's going to be some overlaps with things that we've already discussed. So let's go ahead and consider inventory in the context of the two processes that we've already discussed, or two of the processes we've discussed, purchasing and revenue. So purchasing companies purchase inventory or raw materials for inventory production. So that's true for most organizations, especially if you're talking about manufacturing and merchandising organizations. We could kind of include service organizations there to some degree, but for the most part, there would be operations. They don't follow typical inventory patterns. But most organizations will have merchandise to some extent, even if it's not necessarily used for resale. And then we've got revenue. A lot of organizations sell inventory to generate sales, whether that be manufactured inventory or just retail purchase merchandise inventory. So it hits both of the areas we're going to talk about. That's both good and bad for us. The good news is a lot of this information is going to be familiar and there's going to be overlap. When there's overlap, guess what that means? It means we don't have to learn a lot of new information. We're not going to learn a lot of new details. But it's also bad because it means that there could be some confusion and some issues with things that we do have to learn that's new because they won't necessarily be obvious. So overlap can be our friend and it can also be our foe. It creates a little bit of challenges. We'll see that when we get to the functional areas. A lot of our functional areas are going to be things that we've talked about in other at other sections, other contexts. All right, so inventory documents and records, these are pretty straightforward. These are the ones we need to be aware of. Obviously, the ones that we've looked at before, we've looked at receiving reports and we've looked at shipping orders before because we looked at that part of the revenue process. The rest of these, those are mostly related to manufacturing processes, which is not going to be relevant to most of our organizations or to many of our organizations, I should say. It's going to be on a case-by-case basis. This is also not a comprehensive list of documents, but this is a pretty good cross-section that you should have some familiarity with already. So let's go ahead and get onto it. Let's get into the inventory functional areas. So functional areas of the inventory process. So this is going to be a lot less apparent, a lot less obvious than we've talked about in other areas. Like I said on Friday when we were talking about this, that this kind of devolves once we get a little bit further along. Once we get a little bit further along, it's a little bit more confusing. In some areas, we're not going to have these functional processes that are going to be obvious, but we'll talk about that more next week. So what are we talking about with respect to functional areas for inventory? Well, inventory management. We need to authorize inventory purchases and production. And if we're talking about a retail organization, we need to know when stock comes low for our sales, where we need to reorder. Example of this would be Walmart. They actually have a management of whatever the inventory is on hand on the floor and what they have contained in the back in their storage. And when that becomes too low at a certain economic order quantity point, they have to reorder, and presumably it's going to get to them in a timely manner. I'm assuming that everybody's talked about EOQ and other courses before. And so we're not going to calculate that, but it's a pretty eponymous concept. Then we're talking about raw materials, manufacturing, and finished goods. This is the moment where Dr. Ateros nods in and says, "Are you talking about me?" And yes, we're talking about you, Dr. Atero. So materials, manufacturing. So the three different categories of inventory. Obviously, these are constrained to areas talking about manufacturing process. For the retail process, then we really just have the end result goods, the finished goods, because there's only one form of inventory. But raw materials are what's going to be used for production. Manufacturing is actual production, and finished goods are when production is completed. This is just kind of a rehash of what you learned in managerial accounting or cost accounting, but it's pretty straightforward. Not really too much to be alluded to there. Then we have cost accounting. Cost accounting is maintaining the production and purchase data. So this is going to be a little bit different from our financial accounting concepts. These do flow into the financial statements, but they tend to be separate. Also, does everybody remember from cost accounting and managerial accounting what the rules for GAAP are with respect to internal accounting practices? It's a trick question. There are no rules for generally accepted accounting principles for internal accounting practices. They have to flow into information that has internal accounting concepts, but you can actually maintain your accounting records internally however you want to. It's just the external presentation of information that has to be according to GAAP. So yeah, just a little bit of tidbit of knowledge. Is that going to be on the exam? Absolutely not, but I just thought I'd share anyway. Then general ledger and accounting, again, three-way match. What are we talking about managing? We're talking about managing the same documents that we looked at, purchasing and revenues, but this time from an inventory perspective. So we're talking about what has been ordered, what's been received, and what has been produced. And so all these can be lined up pretty easily. So let's just go ahead and really quickly do our segregation to duties that we've done before. This is actually really easy, but very unsatisfying, extremely unsatisfying for separation of responsibilities here. So if we're talking about inventory management, the description says it authorizes inventory production and purchases. So out of custody, authorization, and recording, which one do we think is most appropriate here? Probably authorization. And the description gives it away. Reading the clue describes the clue, I guess. Raw materials, okay, we've got a form of inventory here. Inventory is an asset, so custody. What about manufacturing? It's also still inventory, so custody again. Boy, doesn't that just really, really grind at you? You're just kind of like, no, we can't have custody twice in a row, Dr. Barnes. It's not allowed. I didn't make the rules, guys. I didn't make the rules. So finished goods, that's also a form of inventory, which means we've got another custody function. So 3 custody functions in a row. Obviously, there should be separate custody chains there. We don't want to have overlap in the inventory that's held as raw materials going to be in production or anything that's held as finished goods. But for the most part, separate custody responsibilities, they shouldn't overlap for the most part. Cost accounting, we talked a little bit about this, but this is obviously accounting internally. So this is going to be one of our recording functions. Again, this is not GAAP compliant because it's just how we maintain the information for internal operational purposes. What is GAAP compliant is the general ledger and accounting functions, which are also recording functions. So I did distinguish these two because this is basically internal. This is going to be what's going to be reported into the financial statements for external purposes. Also, something interesting to note, the book notes that segregation of duties is particularly important for inventory. Why is that the case? Why is that the case? Why is segregation of duties so important? So let me answer this question by asking you another question. Is inventory susceptible to theft? Yes, it is very susceptible to theft. In fact, it's probably the second most misappropriated asset. The first being pretty obvious, that's cash. So the second most appropriate and misappropriated asset because it's very easily liquidated. So presumably we should have separation of responsibilities in any area that involves inventory, particularly as it relates to those 3 functional areas, custody, authorization, or recording. Can we see a living embodiment of this here in Kirksville, Missouri? Absolutely. Has anybody ever gone shopping at Walmart or probably more recently at Hy-Vee? So when you go to check out, what do? You go and stand in line and somebody says, hey, happy to help you. It scans your merchandise. Is that the way it goes most of the time? I mean, sometimes they have it like they've got like about 50 different cashier lines and like one of them has got a person standing on the stands. But what happens usually when you go to check out? Who's the one checking out? We are. We're the ones checking out. If you're the one checking it out, is that a problem from an auditing perspective? That's a pretty big breach of lack of control. So who's responsible for the custody and authorization and recording of the transaction there? We got all 3 roles and responsibilities. I wonder if Walmart ever experiences theft because somebody says, I'm not going to record this transaction because I don't feel like paying for it. Instead, I'm just going to put this pack of gum in. I'm going to look like I'm swiping it, but it's going to go right into the bag and I'm going to walk out. It's like, oh, yeah, it's been paid for. Yeah. I wonder if that ever happens. Well, interestingly enough, Walmart's actually shared statistics on this, and their shrinkage actually doubled in the time that they've actually gone to customer-generated register systems. So shrinkage is just a fancy term for theft. That's what they've disappearance of inventory. I think their theft percentages, they said something that was along the areas of 1.5%. It's gone up to like 3% since they've implemented those, which kind of tells you how much they want to avoid paying additional workers to do the work for them. Then again, you may make the argument that it's really, really hard to find people who want to do that job there, but that's splitting hairs, I guess. Anyway, it's not for me to criticize Walmart. I apologize, Walmart. It's nothing personal. I'm just trying to use you as an object example. Okay. See, I have to make that statement to YouTube. That way I don't get sued. So, yeah. All right. All right. Dirty words. All right. Anyway. So let's talk about inherent risk assessment. So what should the auditor consider part of the risk assessment for inventory processes? So what has been our primary risk area that we've talked about in the other process areas so far? So industry factors, things that relate to the industry. So industry conditions, okay. Competition and new entrants. Can this be a big concern with respect to inventory? Well, on both ends, yes, absolutely. If we're talking about generation of inventory for resale, then there's going to be certainly problems if we have new entrants into the market because there's going to be people competing to try to sell the same items. Can it also be held for items that we're trying to acquire? If there's competition for raw materials, that means the demand's going to go up, so prices will go up as well, which definitely can lead to a risk. What about changes in technology or obsolescence? Do we think that may be a problem that we have to face with respect to inherent risk? This is one that auditors face very, very thoroughly. Obsolescence becomes a real problem because technology becomes obsolete. What are the chances of being able to recapture the cost on it? So I've got this device right here that I really used to love. Did anybody recognize one of these things? This is a BlackBerry, okay? It's not one of these monstrous devices that I'm holding in my hand right here, okay? This was a sleek and elegant device that BlackBerry did not do a very good job of supporting, and therefore it became obsolete, okay? So the reason I love this is because I've got really, really awkward and big thumbs. So actually having the keys to press on. I type in words on this one, you cannot recognize it like it's Typo City, and I'm already bad at typos as it is, so It's just it's like sometimes like it does the autocorrect and I'll like type in and then it like names of countries I've never heard of come up as the words that are answered. So yeah, I missed the BlackBerry very thoroughly, but they didn't do a very good job. So getting back to the problem, let's say that you are auditing a company and they've got boxes of BlackBerry devices that they're holding at cost. What are you going to have to say as the auditor? Say, yeah, you need to write those off. You're never going to sell them. They're saying, no, the market's going to turn around. There will be demand for this in the future. I said, well, maybe if we go back to the Stone Ages, but probably not in the near future. We're going to assume that this is probably never going to happen. Technologically speaking, we do have to be very, very aware of these changes. All right. What about some fraud risks? Well, didn't we just say that inventory was very susceptible to fraud? Yes, it's very susceptible to fraud. I'd say it's probably the most susceptible item to fraud. Now, you may say, no, you just said cash is more susceptible. I said cash is more susceptible to misappropriation, but inventory is still very susceptible to misappropriation. We concern ourselves very heavily with stealing of inventory used for resale purposes or for personal purposes. If you're like me, you go to the store and says, I really don't feel like paying for cheeseburgers today. I'm just going to steal the cheeseburger stuff. So I'm not going to use that for any purposes other than my own, but it's still considered misappropriation of assets. You notice I'm specifically saying misappropriation assets. Is that the only type of fraud we've talked about in this course? We've also got fraudulent financial reporting. Can inventory be related to that? So what happens when we inflate ending inventory? What happens to our cost of goods sold in a periodic inventory system? Goes down. What happens when cost of goods sold goes down? The income goes up. What does that mean for our company? They say, hey, look, we're performing better. Like fraudulent increases in ending inventory can actually increase income, which is, again, counterintuitive unless you know the accounting equations. But yeah, that's something that's a very, very common characteristic, common trait. Also, related parties and buying and selling. This is not necessarily fraudulent indicative, but it's fraudulent adjacent. If we have organizations that are operating with us that have related partner relationships existing, they may get preferable terms based on buying and selling patterns. So we need to be aware of that. So something concerned. So a lot of concerns, particularly with respect to fraud, when we think about inventory here, that is probably the most susceptible area for fraud as it relates to financial statements or financial statements and misappropriation overall. All right, so I'm sorry to say we are not yet off of a reliance strategy. We're still using a reliance strategy. What does that mean about controls? It means we have to plan and perform and test controls. What does that mean for you all? It means another table and another table. So good news is this is the last table. This is the last table, so you can cheer a little bit. We don't have any more tables next week. So I do want to clarify something. If you start looking at the exam, you will notice that one of the problems has a series of controls-based questions. That's going to be very similar to the question that I'm going to ask on the exam, okay? The problem I'm going to ask on the exam. It will come from one of three areas. It will come from either the two tables on the revenue chapter, chapter 10, the two tables in the purchasing chapter, chapter 11, or one table from chapter 12, payroll and human resources, and one table here from inventory. I'll include both of them. Now, I believe the example that's on the practice exam that I gave you is a revenue example. I could be wrong about that. It could be purchasing. I don't remember off the top of my head. Do not read into that too much, all right? If you see it says, oh, he gave us a revenue example for the practice exam, that means he's not going to do a revenue example for the actual exam. This was words that were given to me by one of my students several years ago, and I said, you know what, they're right. I'm not putting the same example on the practice exam as I do on the current exam. So you can thank that student for now the possible chance that I would give you revenue 2 times in a row. Okay. How do I make the decision? I go to my room or go to my office and I roll a 3-sided die, which there's no such thing, but I do it on a computer. Okay. So number 1 to 3 with revenue 1, purchasing 2, and then the other 2 is 3. And I do a choice like that. So I don't want you to read into it saying, okay, I don't need to memorize revenue. You don't need to memorize anything, but you do need to learn all 3 of them because there will be possible questions from all of those. But that example is what the exam question will look like. All right, so we've already talked about this. Table 13.5 is what you need to look at, and it's going to have the same characteristics. Control sequence is going to have the assertions listed. There will be multiple risks under each assertion. Usually, sometimes there's only one. And then there's going to be controls and test of controls. By the way, it's really, really important that you delineate what is the difference between a control and a test of control. A control is implemented by the organization and represents its response to the risk. A test of control is what the auditor does to make sure the control is operating properly. Why am I mentioning this? I may have had some confusion from some of my students on the comprehensive exams, and they're saying, the graduate students, they should know it. I said, yes, they should, okay? But I definitely had more than one student respond with a test of controls that was actually a control, okay? There is a difference between controls and test of controls. It's really important to understand that distinction. All right, so what is an example for assertion that we're going to be facing here? So completeness with respect to inventory. So what does completeness represent? It's our recording assertion. So what does that mean? It means we're concerned about things that did not get recorded. Have we encountered anything with respect to completeness related to inventory? Yeah, remember we talked about floor to sheet and sheet to floor back in chapter 5. Talked about inventory testing back then. Which one was floor to sheet and sheet to floor? Which one was completeness? Floor to sheet, yes, starting at the floor and moving up to the sheet because the sheet represents one in the system. So floor to sheet, floor to sheet was completeness. So yeah, inventory being received and not recorded. So that's our concern there. We have stuff that we have in the warehouse, but it didn't get recorded in the system. So if you are the client, what would be a good control to make sure that everything gets received is actually recorded? Well, let me ask you this. Do the clients generally get items or get documentation to accompany the receipt of inventory? So they actually get those. Those are usually going to be documents that represent the receiving items, so the receiving reports. You can actually say they get their purchase order, but they usually generate a report based on the purchase orders, which is going to be the receiving reports. So the aggregation of that, okay, the receiving reports. So you have a source document that we can use to say this is what was received. Did it actually get put into the system? So we'll go and make sure to match the receiving reports to the vendor invoices and what goes into the purchases journal. So that's the control, okay? That's the control, is that matching and document matching. How are we going to test this for an auditor? How are we going to test this for an auditor? What did we just say the direction was? We're talking about bottom to top. Bottom to top is what direction is going from bottom to top? What is the test associated with bottom to top testing? Tracing. So we're actually going to trace a sample of vouchers to the purchase journal. Now note this word vouchers is a little bit deceptive. I would start with the receiving reports, but you can also use vendor invoices as further evidence. The voucher is just that package of documents that's generated as part of the purchasing process. You can also do this for the receiving process. They will also generate documents. But we want to actually make sure that the source documents indicate that something got reported to the system. So we're starting with the source documents and moving up to the system. Now, how would this change if we're talking about existence occurrence? Could we do a similar task to this for existence occurrence? Yes, because existence occurrence is just basically top to bottom. So we say, we have stuff in the system, stuff that's on the sheet. We want to make sure that it's actually in the warehouse. So instead of starting with the receiving reports, we start with the purchase journal and go down to the vendor invoices and the receiving reports. We just move in a different direction and we'd be vouching. We'd be vouching those. So, by the way, this word vouchers over here, this does not imply that the process of vouching. Those are two separate concepts. The voucher here in this context is talking about that package of documents that you talked about, that you looked at back in chapter 6 for your testing controls. So it should be more of a voucher package. All right, so substantive analytic procedures. So can we use substantive analytic procedures with respect to inventory? The answer is yes, but sparingly. You will notice that there's a lot of uses of the word compare up here, which implies that we're looking at ratio analyses and trend analyses to try to identify outliers for further investigation. Generally speaking, we do not use reasonableness analysis for analytical procedures, as we're not going to develop estimates or expectations with respect to inventory. There are some minor exceptions, but they usually are small immaterial accounts where analytical procedures would be testing or would be appropriate. I would say a big area that we would use with respect to inventory is going to be gross profit and cost of goods sold analysis. We're going to look at transactions that relate to, look at figures that relate to those two amounts and see what their trends are over time to see if there's any meaningful deviation from period to period. If you see cost of goods sold percentage of sales change substantially, that's something you as an auditor will want to investigate the reasoning behind that. Sometimes there are external reasons to explain that. I gave you an example of the pandemic and the purchasing process that occurred way back then, how those changed cost of goods sold pretty substantially. Sometimes there are internal mechanisms that we need to be aware of as the auditors. But for the most part, it's a pretty rote series of comparison items. All right, let's go ahead and get into audit procedures. We're going to do the same thing we did for the payroll process. I'm going to give you the audit procedure. We're going to talk a little bit about it, and you're going to give me the assertion that's being tested here. So trace a sample of receiving reports to inventory records. So we've got a tracing process again. Now, before we answer this question, what do we always do when we see the words tracing or vouching? We check to make sure that they're moving the correct direction. So the inventory records would imply that going to the system. So we're starting with a source document and moving to the system. So it's tracing used correctly here. Yes, okay, so we are correct. By the way, you're going to ask, would I ever deliberately use that incorrectly? On the exam, the answer is no. All right. In the class, no holds barred. Okay, I'm going to check and make sure your knowledge is comprehensive. But on the exam, I will never try to fool you. I'll never try to mislead you. There was one exception to that. I got confused when I was writing an exam. This was like 7, 8 years ago. I don't know what was happening. Apparently, I was drunk. And I don't drink, so it was really weird. So yeah, but I talked about tracing when I meant vouching and vice versa. It was really embarrassing. So it happens to the best of us. It's going to happen to me too. All right. So we're talking about tracing here. What assertion are we testing? Completeness, yes. Recomputing mathematical accuracy of a sample of inventory transactions, okay, and auditing standard costs or ever the method used to price inventory. These are separate tasks, by the way. We're going to talk about how we audit standard costs here in just a bit. But recomputing is mathematical accuracy of a sample of inventory transactions. Pretty standard test, making sure that what aligns with the client, making sure that that is consistent with what our expectations are. That recompute is a big term because that implies a specific test that's unique to a single assertion. Which one is it? BAA, very good. Examine a sample of inventory checks for proper classification expense accounts. Yeah, I hate it when I do that. I still use the name of the assertion and the description of the assertion. But we're trying to make sure that we're putting in the proper expense accounts. This is particularly important when we talk about this. This is actually go beyond just expense accounts. This can actually go to inventory classification accounts. We don't want to misclassify something as raw materials that's going to be in work in process or work in process as finished goods and so on and so forth. So obviously this is going to be classification because I said the word classification. Someday I will fix the slides to do that, but today is not that day. So here. Review a sample of time cards before and after period into the appropriate weekly inventory report. So larger question here. Why do I concern myself with time cards with respect to inventory? Isn't that payroll? Do we know that payroll can flow into inventory? You know, we talked about that on Friday, saying that if we're talking about inventory related specifically to production, it gets capitalized as a cost of inventory. So we do need to actually test that as part of the inventory process. Well, but the assertion here is pretty straightforward. If we're looking at before and after period end, we're dealing with cut off. There we go. That's the one I was looking for. Yeah. So yeah, the temporal ones. Yeah, I'm looking at that. Somebody may have said that before, and I didn't hear it. You have to forgive me. In my old age, I'm getting deaf. So, but yeah, cut off. And then vouching a sample of inventory additions to receiving reports and purchase requisitions. This is just the opposite of what we're looking up at here. Okay, the things that are in the system, make sure we have the source documents for those. Sounds very similar to our test of controls, but they overlap to some degree. For vouching, we are testing. This is occurrence. Okay. By the way, is vouching used correctly here? Yes, we start with the system and go down to the source documents. That was fun. Let's do this some more. Verify the inventory held on consignment for others or bill and hold goods are not included in inventory. So we've talked about this concept of consignment and bill and hold. So bill and hold are things that we're talking about. We're the ones who have already been billed for them, but so they're being held by an outside party. So if we do not have possession of the inventory, or we do not have ownership of the inventory, and more appropriately with respect to consignment, then that's pretty much implying a certain assertion that I'm trying to avoid using the word for. So we're trying to determine that this asset is not included on our financial statements. That inventory is not included on there. So very good, rights and obligations. There we go. So we don't have the right to include that inventory on our asset because we don't own the asset. Okay, we don't own it, we don't possess it. I will admit that this next one is really, really bad because this could actually be multiple assertions. I was really struggling because the description for this was like 17 sentences long, so I shortened it to one sentence, like you do. So yeah, observe physical inventory. You can actually say that there's multiple assertions here. The two primary ones are going to be existence, occurrence, and completeness. I just said existence, occurrence. We're going to talk a little bit more about this here in just a second. Obtain a copy of the inventory compilation and agree totals of the general ledger. So we're trying to actually see that the amounts that the client reports matches what their counted totals are. we're talking about a mathematical operation, it's almost always what? BAA, yes. And then tracing test counts and tag control information to the inventory compilation. So basically what's in the system, we're going to check our source documents and make sure that it's correct, it's been put in the system. So that's pretty much consistent with what we've already talked about with respect to tracing before. It is completeness. Yes, very good, very good. All right, so let's talk about some nuanced stuff. So this is kind of the end of all of our trail testing, but inventory has some very unique specific concerns with respect to auditing. So the first thing I want to talk about, again, we're going to talk about standard costs, okay? So does everybody remember from standard cost talking from managerial or cost accounting? So I remember the words, Dr. Barnes, but you're going to have to refresh my memory on what standard costs are. That's something I've become very, very increasingly aware of, is that when I teach this class for every semester for like 11 years, I know what the words mean, but sometimes when I talk to my graduate students, I said, okay, what assertion is this? And I get blank stares. I said, come on, guys, you took 417. It's like, that was years ago, okay? So I realized that it's been some time for many of you in cost accounting and managerial accounting. So fortunately, I used to teach managerial accounting. So here's my quote from Accounting 221. A standard is the price, cost, or quantity that is expected under normal conditions. A standard cost system, accounting system, that uses standards for product costs. In other words, whenever production is recognized, they recognize those costs at standard. What would the standard amount be for those items? So the price and quantity for those. And remember, that was the source of those calculation of those variances, those miserable, miserable variances that you had to calculate. The variances were the source of consternation for many students in my class, because I told them you had to learn how to calculate variances. But the whole point was not to calculate variances, to interpret what the variances actually meant. Remember unfavorable and favorable? Yeah, that was the only time in a course that you could actually use the letters FU and Dr. Otero would approve. Okay, so yeah. Ouch, yeah. I'm just teasing, Dr. Otero. Don't come after me. Okay, yeah. All right, so anyway, so how do we audit standard cost? So how exactly do we add standard cost? So that breaks down to our three types of product costs, which are going to be materials, labor, and overhead. So materials, we want to test the quantity and type of materials included in the product on the type of materials. So we need to make sure that the standard cost associated with the materials is reasonable and representative of what the organization operates from. Otherwise, if they're not, they may be understating their standard costs, especially if they're saying we use 1 pound of production on average. When you look at operations, and most of the people in operations are using like 1.5 pounds every single time they do it. If it's not representative, then we want to make sure that it is truly representative. Same is true for labor. We're talking about the amount of labor needed for production and labor rate. We want to make sure that those are representative. So saying that an individual can produce an item in 20 minutes, and you look at the individuals and they're really, really working hard, and they're still only getting a unit produced every 30 minutes, they may need to adjust that labor rate. And then finally, overhead, we want to make sure we review the entity's method of overhead allocation, reasonableness, compliance with GAAP, and consistency. Is everybody comfortable with that last description and sees no problems with those words whatsoever? I'm trying to trap you. I'm trying to see. Well, wait a minute. Dr. Barnes, you just said that managerial accounting is not subject to GAAP rules, and then you said compliance with GAAP. What gives? I said, you're absolutely right. I did say that. I did say managerial accounting is not subject to GAAP rules, and I hold to that. However, it's important to know that overhead reporting goes directly into the cost of inventory. It's reported to that. And cost of inventory is important with respect to generally accepted accounting principles. Remember that we've got certain ways that we can recognize inventory costs, okay? So FIFO, LIFO, weighted average, those are all going to be approved methods. So first of all, it has to be something that aligns with one of those methods. Now, those are not the only GAAP approved methods. Those are the ones that come off the top of my head. But if we're talking about overhead allocation and how we recognize costs that are going to be held, that has to be consistent with that. It cannot be something that creates inconsistencies between GAAP approved methods. So yeah, making sure it's reasonable, consistent with GAAP, and applies with those rules. Now we're going to talk about one of my least favorite things in all of accounting, inventory counts, okay? Let me tell you something. If you go to auditing and you do an inventory count, which if you go to auditing, it's very highly likely to do, what you have to do is follow these rules, because if you do not follow these rules, somebody is going to get angry. All right, somebody's going to get very angry. In many cases, it will be me. I may not have any idea that you're doing an inventory count, but I will feel a disturbance in the force and I will get angry just automatically. So I want to talk a little bit about some of this, and we're going to share some experience. I'm going to tell you some stories in here. So it's really important to note that all of these have to be met, and it's not your responsibility in a lot of situations. It's a responsibility to follow up on to make sure that other people are doing their job. That is where my problem came in, is that people did not do their job effectively, and I'm the one who paid the penalty because of it. So before beginning inventory account, an auditor should do what? So the very first one is ensure that no inventory production or removal will occur during the account. This is at all possible, we try to do that to as much of a degree as possible, right? If it's possible to make sure that there's isolated opportunities for inventory movement, then we try to do that. This is why a lot of times when you do a year-end client, that you'll be spending New Year's Eve at the client. You'll go basically like say, all right, January 1st, 2000, whatever, and you're going to be saying, all right, trying to start the inventory count. Has that happened to auditors? Yes. Does it happen as frequently as it used to? Not really, but it does still happen. For some organizations, this is literally impossible. Like someplace like Walmart that does their inventory counts, they can't stop inventory movement, so they can only just take their best guesses. But if you've ever seen a Walmart inventory count, it's fascinating. The companies that are doing the inventory count, they're scanning and trying to get the merchandise count, and people trying to buy, and they're slapping their hands down saying, I haven't counted that yet. I mean, I'm not even doing hyperbole. That's literally what happens. It's crazy. It's just mad. But for the most part, I want to try to make sure no production, no sales, nothing, no movement will occur during the count. We also want to make sure that you verify the count documentation is properly assigned. It's important to note the count is not conducted by the auditor. It's conducted by the client and the client personnel. But we want to make sure whoever's doing the count knows what they're counting and what their role is in the count, so they know exactly what areas they're assigned to. This is the most important one. Ensure that the instructions for the count are clearly understood by the count teams. This is where I came in because I did my inventory observation and I was doing the count and working alongside. Now for this one, I was in a very unique situation. I was in the middle of Oklahoma in a very small town that was just south of Oklahoma. And the reason I got put on this is because I was working in the Dallas office and I volunteered since I was going to be on in Oklahoma for a holiday break anyway. And that was a big mistake, okay? Because I ended up having to climb on top of a 200-foot tower on a narrow stairway to count chemical storage, okay? And this is the middle of Oklahoma on like January 8th or something like earlier January, maybe January 2nd or January 3rd. And it's not as cold in Oklahoma as it is in Missouri, but it still gets cold and very windy. On top of a 200-foot tower, windy, all right? So I don't want you complaining about any of your unpleasant inventory experiences. I will trade. But I did not have good instructions that was carefully articulated to me or to the count team. So when we actually identified variances, I did not know what to do. I contacted my senior. My senior was on holiday break and probably ignored me for like 3 weeks. And then when I was back in Dallas, they said, okay, what were your counts? And I said, I emailed you like 3 weeks ago. And then they said, well, why didn't you tell me earlier? I said, I did. You didn't respond to email. And then we got into a shouting match. It was really, really unfortunate. But yeah, so that's really, really important to make sure that everybody knows what their responsibilities are and that it's clearly articulated to both sides. If there are variances, if there's issues, we've got to make sure that those issues get addressed. So as I've said, we are the auditors. We're not doing the counts, but we can perform some additional backup procedures, which we're going to talk a little bit about. So we want to know that we're going to be testing some assertions as part of our testing. We're going to be mostly observing the client as part of this, but we're going to be actually doing some additional counts that we could do on our own just to make sure everything's correct. They're called test counts. Observation is just as it sounds. When we're observing the client do the count, it's an observation procedure. When we're doing those test counts, that's a reperformance test. They hit exactly the same assertions, but one is markedly more reliable than the other because a reperformance test is performed by the auditor. All right, so what are some things that we can actually test? What are some assertions areas we test? Well, existence occurrence. This one's pretty obvious, okay? We're comparing inventory quantities to the record on the observed inventory, or on record of the observed inventory quantities, that sheet to floor, making sure that what's in the system matches what's on the floor. And then completeness, which is exact opposites, comparing quantities of inventory quantities on hand to what's on record, so what's on floor to sheet, which we've talked about before. Also, VAA we've talked about before. Observe the condition of inventory for items that be obsolete, slow moving, or carried in excess quantities. So VAA can actually be with errors in transactions for value, but we also want to make sure that if there's anything that's being held that should not be held or should be adjusted for the holding amounts, that we actually make the adjustments for that. Or we insist the client make adjustments for that. And then we've got rights and obligations. Rights and obligations are going to be those consignment or bill and hold basis items that we were just talking about before. If there are items that are included in inventory that should not be held by our client, we need to tell them get rid of that. Vice versa, there may be also items that should be included in inventory that have been written off or been regressed as sold that we need to address those as well, because those are something that should be held as inventory. Something I want to include on here is going to be cutoff. It's important to know that cutoff relates to transactions event assertions, which are still relevant to substantive testing, but they will not be relevant to account balance assertions. So cutoff, we want to make sure we obtain the necessary cutoff information, including the last shipping or receiving documents issued. This is really important for making sure that we track and identify sales that are recorded in the proper period. Even though this relates more to revenue process, it is a tracking of inventory activity. So that's something we're going to be very checking about. All right, so yeah, all of those things are things that we've already talked about to some degree at other parts of the course. There's nothing really new here, but these are things that you would observe as part of the inventory test that you would need to be aware of that you're trying to test for. I would say primarily in an inventory account that you're very concerned about existence, occurrence, and completeness, but all of the others are going to be concerns to some extent that you'll want to make sure that you're testing as part of that. So some last considerations that we need to talk about. We need to talk about what are some reasons for book to physical differences. So book to physical, that's something, a concept that you're probably already familiar with. The client says they've got on hand a certain amount. The actual amount on hand is completely different from that. So what are some reasons that that might occur? Well, inventory cutoff is one of the ones that we just talked about when they recognize a sale of merchandise and say it's been shipped out when in fact it hasn't. If it's not been shipped out, then generally speaking, that means that the client has not met their performance obligation and they have to recognize that inventory in their system. Unreported scrap or spoilage, if there's items that cannot be sold because they were recognized as scrap or spoiled, then we have to remove that from the system. That's going to be something that's going to be removed from the client's book. And of course, the natural one, pilferage or theft. Has anybody heard that term pilferage before? I'm not sure. This is something that I copied from the notes that I had from the client or for the book. But to my knowledge, pilferage is just a fancy word for theft. So basically, I just said theft or theft. All right. So maybe there's a new meaning. I'm always looking to determine that, but I probably should adjust that one. We also need to know the inventory cost method, FIFO, LIFO, retail, et cetera, et cetera. It's really important to note that we need to make sure, especially on publicly traded clients, that they are using a GAAP approved method for inventory valuation. So that's something that comes up from time to time if there's not an inventory approved method. Now, noting, I think we talked about this in the course. We had an example of this already in this course. Adjusting costs like the market valuation inventory method is not currently legitimate under GAAP. You can't adjust inventory methods. They're all historical valuation, but you can choose what historical valuation you want to use, whether that be FIFO, LIFO, or retail. We're going to talk about LIFO more here in just a second because it's very interesting. Any purchase contracts, consignments, pledged or assigned inventory. So purchase contracts, we already talked about consignments and pledged or assigned inventory. Recognize inventory that might be already committed to certain individuals or any purchases that we may actually have to engage in the future. Those need to be aware of for the auditors. All right, LIFO liquidations. How many of people have heard the term LIFO liquidation before? All right, I'm about to expand your horizons. All right, so LIFO liquidations occur when the amount of inventory that is sold is greater than the amount of inventory produced under a LIFO system. Now, why is this relevant to LIFO? This actually can be true under an inventory system, but LIFO is the one that we're most concerned about. Let's think about why. So first of all, if you sell more than you produce, what does that mean about your inventory balance over time? So you may say, Dr. Barnes, how is it possible for anybody to sell more than they produce? That's just not possible in the real world. So it is, okay? It just means that you had inventory on hand at the beginning of the year, and that balance of inventory on hand at the beginning of the year has been reduced to the year end, okay? So say I have 1 million units of inventory on hand during the year. I'm going to dip into some amount of those inventory units. Now, those inventory units at the beginning of the year were held at LIFO, which LIFO means what? Yeah, everybody's with me on that one. All right, so last in, first out, okay? What is the natural trend of prices over time, especially prices for inventory? Do they go up or down? They go up, okay? Inflation, you know? So if we're talking about last in, first out, those 1 million units that are in there, they're going to be at a much lower cost than the inventory that we would purchase during the year. So when we sell that inventory, or I should say our client sells that inventory, what are the costs for those inventory that's going to be held in the beginning inventory? What are those costs going to be? They're going to be lower than the cost of other inventory we sold during the period. So then what is that going to do to cost of goods sold for that period if we sell more than we produce? Going to make the cost of goods sold margin go way down, or the gross margin go way up, cost of goods sold percentage go way down. So you think about it, you're selling inventory that costs less, quote unquote, inventory that costs less because of last in, first out. Now, is that sustainable over time? Is it possible that you can sell a little more than you produce or sell more than you purchase over the entire life of your organization? Not a trick question. I'm just trying to see if you guys understand here. You can't sell more than you produce over the entire life of your organization. That would be fraud right there if you're trying to do that. So we're only producing 10 units, but we're selling 1 million every year. I'm not sure how we're pulling it off. Okay. So at some point you have to produce more than you sell, or you have to buy more than you sell. So if that's the case, if you're going to have exorbitant income in one period, should the stakeholders know that that's not a sustainable amount? So their income, the net income for this year that you had a LIFO liquidation, because the reason it's called LIFO liquidation is your inventory is held at LIFO because of the cost being so much lower than what you would normally recognize. You realize much higher income for that period. And so the stakeholders know about that, or because they're going to expect that those income levels are going to be sustainable over time. That's where the auditor steps in and says, you need to disclose that you have the liquidation of existing inventory, and that's what drove that income up, drove costs down and drove inventory up. If you fail to disclose that, people are going to panic when your income goes way down in the following period. How do we know that? How do we know? Because that possible that might have happened in the past? Yes, okay. There's a really famous airline, Southwest Airlines. Is everybody familiar with Southwest Airlines? Yes. They did this. They actually had it wasn't quite LIFO liquidation, but something very similar. They had a hedging agreement for fuel for a very long period of time. This was like mid 2000s. And if you weren't aware, in the mid 2000s, we were actually operating at like $1.50 to $2 a gallon, and then it spiked between $3 and $4 a gallon for like about a 5-year period. Southwest hedged their contract for that period of time to be the same price that they were paying at that, and so they were recognizing ridiculous amounts of income. They were telling their stakeholders, okay, we're recognizing a lot of income, but this is not going to last. Okay, when the gas prices the hedge runs out, the purchase agreement we've got runs out, then we're going to be going back to more normal levels of income. And sure enough, 2009 hit, and their income flattened out. Guess what stakeholders did anyway, or stockholders did? Their purchase price still went way down. Their purchase price still went way down. I was like, how can this happen? We didn't have any idea. It's like, we told you it was going to happen. So that's why it's so important for disclosure, because imagine if they'd never said any disclosure about this whatsoever. Only the really, really knowledgeable people about gas prices and the hedges would have been aware of what's happened. That would have happened, it would have just crashed to the floor. So yeah, LIFO liquidation is really, really important to note. So what is our auditor's responsibility? If there is a LIFO liquidation, we have to make sure that our client discloses this information. It is a responsibility of the auditor. We can be held liable if there's a failure to do that, because that's going to be something that's in stakeholder interest to do so. Purchase or sales to related parties. We've already talked about the nature of related parties. A related party can be both on purchase and sales side. Remember our responsibility for related parties as auditors. The first thing we have to note is are the transactions representative of arm's length transaction? Okay. Remember, arm's length is shaking a hand with somebody. That's how you negotiate a transaction. They're close to arm's length, and they're certainly problematic. But more importantly, we as auditors have responsibility to make sure that all related party transactions are disclosed by our client. Okay, that is required under GAAP. Related party transactions must be disclosed. So if we as auditors fail to enforce that, we can be held liable in that responsibility as well. This occurs pretty frequently with inventory transactions, because it's very, very common that related party transactions will try to do business. Related parties try to do business with larger organizations. And then to our warranty obligations, these are going to be for merchandise, especially long-term or durable goods where we actually have use for longer periods of time. There may be certain service agreements that go associated with that. So those have to be incurred as cost of the inventory, recognized as necessary. So there has to be an expense and an allowance associated with that, very similar to an allowance for uncollectible accounts, but usually this is going to be an allowance for warranty obligations in the future. We have to make sure that that's going to be met. Anything that's associated with allowance would have the same primary assertion concern for respective auditors. What did we say the allowance for uncollectible accounts assertion concern was? I guess I should say, what is the primary assertion associated with the allowance for uncollectible accounts? BAA, and that's going to be true for most of our allowances with respect to the financial statements. But yeah, that pretty much wraps up inventory. We have homework on Friday, so I'll see you all then.